Hey everyone, my name is Matt Walsh from Castle Island Ventures. Really excited to be chatting with Anton Katz from Talos today. Anton, great to chat with you.
Hi, Matt. How's it going? Thanks for having me.
It's going great. It's an exciting time to be talking about trading, infrastructure, lending workflow. It's not like there's anything that's going on this quarter, huh?
No. This should be like a very straightforward discussion. Yeah.
Well, why don't we set the stage? We're investors in Talos, so I know a lot about Talos, but would love to maybe just set this up with you telling us a little bit about what Talos is and what was the impetus for starting the company.
Absolutely. And you actually have been one of our first investors. So thank you very much for all the support over the years. Talos is almost 4 years old. And SCB is also an investor in Talos now as of this latest round that we just raised. But Talos, in essence, we connected in a short, a very short description of it is that we're connecting institutions to the underlying asset class. We allow hedge funds, we allow banks to trade crypto, and we provide the infrastructure to do so. And that's really, the background, my background and the background of our team. We've done quite a lot of that work in capital markets. And when we've seen the evolution of digital assets, it was very clear to see that these kind of technology, these kind of systems will be needed for crypto as well. So our job is very simple. We want to make sure that institutions, whether it's crypto native institutions or traditional institutions coming over from more traditional asset classes, have the same tools that they're used to, the institutional grade investment tools that they used to interact with crypto. So we provide, connectivity. We aggregate connectivity across multiple exchanges, OTC desks. We provide algorithmic trading, portfolio management. We provide, APIs, UIs. We now have clearing, settlement. So really think about it as an umbrella of tools that allows any institution, whether you're on the buy side or whether you're on the sell side, to effectively trade digital assets. We act as a one-stop shop for these kind of players.
There's I kind of have a temptation to just dive into the weeds when I talk about crypto market structure, but I think it's really important to just take a step back and say, well, like, why do these institutions actually want to hold or transact in digital assets? And what is the actual thesis for why they would want to own any of these assets, whether that be Bitcoin or Ethereum or eventually shares of actual real world securities on the blockchain? So what do you see as that unifying thesis right now that is actually driving your customers into the category?
Well, I mean, we, generally speaking, when we started the company, we were primarily focused on buy-side institutions, and that's actually half of our customers. And the thesis there varies. Buy-side institutions can be speculative in nature, so they can be surely participating in an evolving asset class and having some alpha around the direction of the market in this particular asset class. There's some that are a little bit more thesis oriented, whether they are thinking that crypto specifically is going to provide capabilities, like storage of value that we haven't seen, efficiency in storage of value that we haven't seen before in other asset classes. But really, we're seeing a pretty wide diversity of different theses that are evolving. There's also, an operational aspect. We haven't even touched the notion of tokenized assets and really seeing how other asset classes starting to migrate to digital assets rails and what that will entail in terms of institutional involvement. So really, we're seeing quite a lot of diversity. The easy, the easy line there is that institutions of all sizes right now are basically have to make a choice whether they will or will not be involved with digital assets. And I can tell you that, while those questions were maybe relevant a couple of years ago, that was a real question. At this point, it's very easy to see so that whether it's for use cases A, B, or C, institutions are involved in getting involved in building capabilities in digital assets. So we're seeing a very, very wide variety of reasons for that, but uniformly, we're seeing them accessing the ecosystem and building towards being able to either trade it on themselves or provide services around it.
I'm certainly seeing that as well. I think one of the common things that I'm seeing is that there's a question around, okay, we want to be in this, but what does this look like? I mean, is this like FX? Should we bring that market structure to bear on this? Is this like fixed income? Should we think about this with an equity lens? And who even should be working on it within our shop? And how should we think about that market structure? So, I mean, is there an answer to that yet, or are we still trying to figure it out?
I think it's very much in the we're going to try and figure it out phase. So generally speaking, there's a lot of similarities between crypto, specifically not just digital assets, but crypto and the way crypto has evolved with respect to other asset classes. There's quite a lot of people that believe, like, look, I mean, the way you trade crypto and the currency pairs that you see, so Bitcoin versus dollar, Bitcoin versus Ethereum, very much resembles some of the stuff, resembles like an FX asset class, right? Foreign exchange, when you're trading one currency versus another. So there's definitely some components there. Some of the market structure, however, the bilateral nature, what we're seeing with OTC desk, some of it actually, and the structured products as well, some of it is starting to resemble the fixed income space. Generally speaking, I don't think it's right to say this is yet another FX or this is yet another fixed income. I think what we're seeing across all the traditional institutions, more and more they're saying, okay, listen, this is crypto. Crypto is going to evolve in its own way. It's going to have familiarity and similarities to other asset classes. And some of the technology is going to look similar, but it's not going to be the same. And actually, I think the interesting part is that, there's a huge experimentation cycle that's happening in crypto right now. We're seeing, like, for instance, DeFi is a great example. We're seeing things that happen in crypto that we really haven't seen in capital markets, definitely from a workflow perspective, from an efficiency perspective. So ultimately, what I think is going to happen is that we're actually going to see impact on existing asset classes, and we're going to see the migration of existing asset classes to digital assets rails. And we as Talos strongly believe that while right now our focus is on crypto, the wider umbrella of digital assets and really the migration of other asset classes on top of digital assets rails is something that we should be, building towards, is something that we should be prepared towards in the future. And I think that that's what's going to happen over the next 5 to 10 years.
I think that's a great lens on it. I mean, if you think about how long it took to get from T+3 to T+2, I think that was like 6 years. And, you're just trying to move a lot of disparate parties and try to get people aligned on a standard. But meanwhile, crypto goes out and just defines its own market structure and just goes. And so maybe in some ways, like you're saying, if we just follow some of the teachings of, public blockchains, we can actually bring traditional securities into just a better system.
That's honestly what I think. And again, like, there's a lot of things, we often talk about the evolution of the crypto market, and especially, one of the interesting parts there is that it started evolving from the retail side, which is kind of like different from what we see in capital markets, right? A lot of these are professional asset classes that evolved from the institutional world. So when we're seeing this, people tend to get used to different timelines. They go like, oh, like, if we were to see institutional adoption, we would have seen full institutional adoption already. But that's just not how the world works. Institutions do take time. There's quite a lot of processes in place. We also need to make sure that, we're not introducing systemic risk. And one of the things we've seen over the past couple of months is obviously like the introduction of, we've seen that risk come to fruition. What happens when the risk goes bad, right? So I do think that we should get used to slightly bigger timelines when it comes to institutional adoption, and especially when it comes to migration of existing asset classes. But Matt, at the same time, I have to tell you, like, this is the fastest that I've ever seen any kind of evolution in especially digital evolution of workflows in traditional markets. So we are already seeing, if you look at FX alone, tons of conversations, and that's been happening over the past year. So 24/7 trading, real-time settlement. We're now seeing this, we started seeing this initially with Silvergate and Signature, but now we're seeing this with other players, with JP Morgan, with a couple of others, even Citi is there now. So the impact to the FX is happening. Now we're also seeing stablecoins. Stablecoins are, again, like, very much aligned with that FX market. I think this is just the beginning of the impact, and I think we're going to see quite a lot of impact over the time, especially in the clearing space, in the settlement space. It's really exciting, but it's going to take time.
Well, I think one of the reasons it's happening so fast, and one of the reasons why these legacy institutions are being forced to actually confront it, is because customers actually want this stuff. And so if you look at things like Bitcoin, things like Ethereum, retail started this, but it's certainly trickling up into institutional, and you're just seeing some startups get really large. And I think you're seeing these incumbents say, well, what business do we have letting FTX and Coinbase and Talos get as big as they are? We ought to compete here. And so, I think at the end of the day, it's just responding to customer demand that's going to bring a lot of probably your customers into this.
Yeah, I think that's right. And we welcome the competition. But look, I mean, the thing is, in traditional markets, especially when you service provider. So here's like how our business works, right? We have half of the clients we have are buy-side customers. Those are people that are using Talos to trade on their own or to trade the capital of their customers. So, like hedge funds, systematics, proprietary desk, we have asset managers that are using our platform. That's about half of it. Half of our customers, and that's been growing very quickly, are service providers. Those are the banks, the lenders, the brokers. We have retail brokers, we have institutional brokers. Those are clients that are taking our platform, white labeling it, and providing services to their customers. Generally speaking, with service providers, and that's lessons from capital markets, service providers don't do things because they think it's a great idea. Service providers do things because they have client demand. Underlying clients, and especially in the traditional world, are coming to service providers and going, you are my prime broker, you are my custodian. I want to be involved with crypto. Is it you, or am I going somewhere else? And we're seeing a lot of these conversations. As a result, we're seeing a lot of involvement from the service providers migrating and starting to provide services and starting to plan or do POCs or actually go to production in digital assets.
So, these firms that are looking at coming in, Q2 has been a doozy. So you have a rising rate environment that's been bad for risk assets generally. You had a top 5 asset in Luna, the Terra ecosystem, just absolutely implode on itself this quarter. You had this 3-Ara situation, which is appearing to be a pretty massive fraud. How is this going to impact just the pace of institutional adoption for this asset class?
Yeah. Wow, man, that was a really downer in terms of like the news cycle, but no, you're absolutely right. That's the right question, and you can go even further, right? We have a weaker macroeconomic environment. We have a war going on in the background. We still have we have a pandemic. From any direction you look at it, obviously the market is a tough market. But that's basically the difference between institutional investors, institutional players, and retail investors. Institutional players take time to build. They're also aware of the fact that markets will go up, markets will go down. The progress and the behavior of these markets is not usually measured in a quarter or two. We're thinking about a year, we're thinking about 2 years. Institutions are aware that if they want to build an institutional solution, that takes 1 year to 2 years to build and to launch. So what we've seen is, we might have seen slightly different timescales, but generally speaking, think about how institutions work. Last year, a lot of these larger institutions already agreed that they are going to participate in digital assets, already have agreed on the budgets, already have dedicated teams. None of that is going away. We have seen, so for us specifically, this past quarter, Q2, was definitely it was the biggest quarter by far for us in terms of closed contracts. So we haven't seen any kind of slowdown. We have seen lower volumes on the buy side by average, but we have also seen tons of new players that are coming in. And on the service provider side, we have seen people discuss maybe a slowdown of a month or 2 to the timelines for releases, but not more than that. We're seeing people building because, again, institutions also know that the best time to build is in a down market. This is when you get to, think through things, design, release to production, iterate, support things correctly. And that's what we're seeing in the market right now. So pretty much across the board, very aggressive forward, very optimistic views towards the future. And then the question is really the timing here.
I kind of get a kick out of it because a lot of times you'll hear people talk about, well, hey, 95% of these cryptocurrencies could fail. And, I guess we're just finding out what it looks like for one to fail really quickly. And I think the same could be said for a bunch of these infrastructure companies, certainly in the lending side, that we're just seeing a new crop of firm will have to emerge here and absorb some of that capacity. And that probably goes for the exchange side as well. So how do you think about that lending and exchange market evolving here coming out of this Q2?
Yeah, I think that's a great question, and again, this is not new. The institutional environment in general is pretty cyclical, right? And especially over the past 2 years, where basically no company could fail because there was infinite money and tons of investment money coming in. What we're seeing is we're seeing all companies, small and big, develop and innovate, and that's a great environment to be in. Right now, in this kind of market, we're starting to see consolidation, and obviously you've seen the news. Some of the largest exchanges are buying some of the providers. Some of the lenders are taking up a lot more market share as a result of some other lenders, giving up that market share. Look, it's a really tough environment, but generally speaking, and that's true for us too. And our job is to come out much stronger at the end of this, and that's where we're headed to. this is exactly the point in time that builds the winners, the strongest players in the ecosystems, the Googles, the Facebook that came out of the dot-com crisis. This is exactly it. So again, there's nothing new here, but we're seeing a very, very fast, and again, like it's crypto timelines as always. So I didn't think we're going to see a consolidation cycle this fast, but that's precisely what we're seeing. The opportunity right now is to build a stronger company, a more scalable company. Potentially there's M&A opportunities across the market. For investors, what we're seeing dollars go to quality. They are looking to back the strongest systems because they know that, ultimately it's a very easy decision tree. At the top, you just have to ask yourself one question: is digital assets a successful, direction? And I think a lot of us believe that it truly is. So if it is, then okay, let's talk about the world that needs to exist for it to evolve.
Has to remind you a little bit of 2018 when you were raising your first round. That was a bit of a crypto winter. I don't know if it'll be the scale of this crypto winter, but turns out that these are great times to start businesses too.
Yeah, and thank you very much, by the way, for supporting us there, because that's exactly it, right? We started the company in 2018, and it was going into investment conversations. We had to basically say, like, we strongly believe in digital assets. We strongly believe in crypto. We believe in institutional adoption. None of those things were, tested and true at that point. And we believe that if institutions are coming, they will need the infrastructure that they're used to, the high bar that institutions need to meet. So yeah, it wasn't an easy thing to start building a company in 2018, but it did give us a year of actually being heads down, building a great company, building a great technology that was able to meet the demand of institutions when that demand surfaced a year and a half later. And that's, that's the result of the result is where Talos is today.
I want to talk a little bit about where you're going and, two dimensions maybe. So lending and then DeFi. Maybe first on the lending front, I don't see this market going away at all. If anything, I think this will be a larger market, probably will look a lot different from how it actually operates. But what type of demand are you seeing for your clients for things like lending, and how do you imagine playing in that space?
Yeah, absolutely. So I think, it's worth to say a few things. First of all, again, we come from capital markets. There is no asset class without credit. That doesn't exist. The capital efficiency is a crucial part of every ecosystem, every traditional ecosystem here, right? And the same holds true for crypto. And we've seen how quickly and how important lending and borrowing became in crypto. I don't think that there is a crypto without lending and borrowing. So lending and borrowing is here to stay, just like it is a part of every other asset class is going to be a part of crypto. Lending and borrowing will change. We, for instance, because of everything that happened in the past couple of months, a lot of people are starting to think about what kind of systems do I need to put in place? What kind of liquidation scenarios do I have? And we've been working with quite a lot of lenders to really put them on our system to be able to facilitate a much safer interaction with their borrowers. So for us, one of the things and this is kind of like the second portion of the answer here, at Talos, like I mentioned at the beginning, right? We care about being the one-stop shop, being the umbrella of services that institutions can come in and really exercise their entire investment lifecycle. That means pre-trade, that means trade, that means post-trade. Part of that investment lifecycle is credit. Part of that investment lifecycle is lending and borrowing. So for us, we've been working on this for quite some time, and that's the stuff we're going to be talking in the media soon. We're releasing our lending borrowing marketplace that's in production testing right now. That's going to allow clients to meet safely, to be able to secure, to negotiate and secure loans, to be able to manage those kind of loans. And the thing that changed for us a little bit because of this crisis is really the importance we're giving to the loan management itself and to the risk associated with that loan management. So really, our job, in short, is to provide institutions with tools that will enable them to lend assets out, but enable them to do that in a much safer way, in a much more systematic way than was available today in the ecosystem. And that's kind of like, that's the stuff we've done with liquidity. This is exactly what we're doing right now with lending and borrowing. So very important for us and a huge portion of where we're going.
Hope you have a blacklist feature. There's a couple of guys that we probably don't want on that platform.
Just send me the names.
Yeah.
You have that right. You're like you're ultimate investor for us. It's just send the names. We're blacklisting.
Yeah, I think public names. The other thing I want to get your take on is just DeFi. And so I see people on opposite ends of this spectrum actually in terms of this argument. So, there's a school of thought that a lot of these DeFi protocols, look, they held up great during this credit crisis here. And so the over collateralized platforms did great. Now, of course, like Terra was a DeFi project, I guess you could argue too. And so that didn't do so well. So how are you thinking about DeFi in terms of just meeting client demand? Is this something that, you think you'll integrate with DeFi protocols at some point?
Yeah, without a doubt. If you asked me that question a year ago, we're constantly in the traditional circle, right? We're talking to traditional clients. Back in the day, it would have been very simple. We would say there's two issues. One is the lack of KYC ML, which is making a lot of institutions really, really nervous. And then the second one is the technology risk, where people don't actually know how to interact with, from a liquidity perspective, for instance, how to interact with DeFi pools. Both of those have shifted dramatically. One is the interest is very, very high on the traditional side, because now DeFi for us is divided into kind of like three areas, and those fit really nicely into our platform. One is data, and there's more and more data available, whether it's blockchain data or whether it's pricing data. Two is liquidity, and now there is more and more liquidity in DeFi protocols that is accessible to traders, and we're seeing institutional traders access it. And three is yield, and we're seeing a bunch of DeFi yield that's available. And again, yield is something that's very, very important for institutions. So generally speaking, for us, it's not a question. We are already involved in DeFi, where, for instance, we're contributing to the PIT protocol, where we're about to announce a couple of other things, but we care deeply. We have a lot of client demand. There are still some questions about KYC, ML, but there's quite a lot of work going into solving and resolving that. But ultimately, I think DeFi is going to be very important to the ecosystem.
How do you think about DeFi in the context of regulatory? So you sort of hinted at the KYC issues, but curious just how you frame just overall regulatory. And I guess make it broader than just DeFi is just what are the hot button issues that a lot of your customers are struggling with now?
Oh man, regulatory is its own panel. So, generally speaking, I think all of us right now, especially with everything that's happened around credit and risk, we're looking to the regulators, because that's the voice that we haven't heard in the room yet. We've seen quite a lot of impact, a lot of people commenting, but not the regulator. I think our concern for quite a lot of people right now, whether the regulator is going to come up with something that is a short-term impactful and a little bit almost like a knee-jerk reaction. I'm hoping that that's not where we're headed to. But generally speaking, we are very much in favor of stronger regulation or of clearer regulation. And I think on the medium to longer term, that creates a stronger market. That's true for DeFi, that's true for CeFi, that's true for anything that involves institutional retail sector, because ultimately the regulator is focused on reducing systemic risk, on making the ecosystem safer and stronger. So for me, we work quite a lot with the regulator, and we're increasing that right now. We strongly believe that there's it's a path that you have to take with the regulator, not against the regulators.
I guess today is an interesting day to ask the question. So the SEC came out and there was an insider trading charge against a former Coinbase employee, and the SEC has named 9 assets to be unregistered securities, but it's really a regulation by enforcement. It's not like there's an overarching framework. And so, I think what you're saying is that, hey, this is a market here that could be a lot larger if we just knew the rules of the road. And if there's securities, some of them are securities, that's fine. Let's just have that framework in place. It could make the market quite a bit larger.
I think that that's exactly right. I think that every time, the biggest thing, like if people ask us what the real barrier is behind the strongest, the largest players in the ecosystem, especially in US coming in, every single time the answer is regulators. They're just looking for clarity. And I do believe we're going to get there. And I think that regulators do create a stronger and a wider market, to your point. So yeah, I think that's where the wind is blowing.
How do you think about some of these maybe step 2.0 in terms of regulation around things like market structure and best execution and some of the things that exist in regulated non-crypto markets? Do you think we'll see those concepts come over to crypto as well?
To an extent, I hope to, because a lot of these concepts were built because of events in the past. So there's absolutely, reason to believe like the FX code of conduct is a great example. It took years and years and years to get that done. and get to the point where institutions start behaving a little bit, on a fair ground in effects. And that's just one example, but there's quite a lot of other regulation. So there are quite a lot of things that you should borrow. At the same time, crypto is a different asset class and it's evolving in a slightly different way. So I do think that there should be a conversation, especially with the players in crypto, but that conversation between the regulator and major players is crucial to actually tailor the rules correctly, not to burden the market, but actually to allow it to foster, because that's where we're headed to. And especially in the United States, if we don't see that happening, we will see the business migrate away, and we've already seen some signs of it, of business migrating to EU, to APAC.
Yeah, you definitely don't want this to just flee the United States. So it would be a real shame to have this innovation just happen everywhere else except for the United States. So we're coming to the end here, but you just raised a lot of capital here, and it's a pretty interesting time to be putting it to work. And so what's on the horizon in terms of what you're building and what type of roles you're hiring for?
Oh man, so first of all, go to talos.com. We have a careers page there. We're hiring across the board. The capital has, we had quite a lot of reasons to raise it, but the first and foremost was to actually secure the relationship and the strategic partnerships. We have an SCB bank is one such great example, but we had obviously the launch was led by GA. Stripes came in as a big player to this round, but we also had Citibank, and we had Wells Fargo and BNY Mellon in there. Fidelity participated again. So for us, this round was again like making sure that we are aligned with the strategic partners. In terms of the capital, obviously, as I mentioned, right, we're continuing to develop this umbrella of services and our partnerships across the board with multiple custodians, liquidity providers, settlement networks, risk providers. We'll continue evolving that umbrella, so that, requires capital, requires scale. We are growing substantially in EU, in APAC, after, our market has effectively went from 90% in US to something like 65% US, and now the rest is between EU and APAC. So growth is a big deal for us. And there's quite a lot of other things going on. And especially, the last thing I would say is capital helps, because in a market like this, we don't have to be concerned. We can continue aggressively going forward and building towards what we know is going to be the future of financial systems. So it helps to have this kind of backing, these kind of players behind you, but also the kind of capital that we have.
Well, we're really excited, and it's always great to chat. Thanks for doing this, Anton.
Thank you very much. Thanks for having me. And thanks for all the support over the years.